should be only for infrastructure sector. AFC for financing the import of infrastructure equipment. Capital expenditure for maintenance and operation of toll system for road and highway. SIDBI can borrow to lend to borrower in MSME sector. Payment of spectrum allocation 2G and lending to self-help group or a microcredit or microfinance activity by NGO. So these are the restrictions are there for end use. Infrastructure sector covers, because if you see everywhere in the permitted end use, many places it's allowed to infrastructure sector. So what all fall under infrastructure sector? So power, telecommunication, railway, roads, including bridges, seaport and airport, industrial park, urban infrastructure, mining, exploration, and refining and cold storage and cold room facility. So these are only covered under infrastructure sector. Amount and maturity. What is the limit? So companies other than service sector can go up to as high as $750 million. Service sector, 3 service sector are defined. Hotel, hospital and software they are allowed. Up to 200 million. NGOs up to $10 million. NBFCs up to 75% of their own fund. And SIDBI up to 50% of their own fund. Now there is a maturity period restriction also. It's not open-ended. So when the ECB is up to $20 million or its equivalent, the average maturity period has to be 3 years. And if it is above 20 million, up to 750 million, because 750 million is something which is highest covered under automatic route, then the average maturity period has to be 5 years. So this clearly shows intention of the RBI that they want that even if some foreign currency is coming to India, then it is for a little longer period. So then it is utilized for good of the economy, and then even if that money is going back in foreign currency, then we are okay. By the time probably enough employment or enough resources would have been generated using that money.
Question related to eligible borrowers, where there are 3 categories: manufacturing, infrastructures, and real industry.
Yeah.
While you are given a limit of receipt borrowing, which covers the software sectors. So when no one is eligible, how can this limit come from?
Who are not eligible?
In an eligible borrower, there are 3 things: that manufacturing, infrastructure, and real industrial sectors.
Correct.
In real industrial sectors, 3 categories are given.
Yeah.
And manufacturing, so software is neither manufacturing nor in infrastructures.
No, but software is covered under real industry.
Real industrial sector.
So there is a separate limit for that, you see. For hotel, hospital and software it is 200 million.
Excuse me. Just get one clarification on borrowing by individual of $50,000 USD.
It will come. See what I suggest. You are free to ask question, but it's better that whenever that particular thing comes, then ask them, because otherwise see we will get diverted to that, and then again we have to come back here. So better that we go with the flow of the slide. That specifically it's there. What you are talking about is there in my presentation. Yeah. What is the cost? How much interest you can give? It's not that any amount, whatever you feel appropriate, you can give as an interest. So then there is a condition that if your average maturity period is 3 to 5 years, then it should be 350 basis point over 6 month LIBOR. So it cannot be more than this. And LIBOR presently is roaming around, I believe, between 0.30 to 0.5. So that means your cost of borrowing will be around 3.75 to 4%. For more than 5 years, 500 basis point over 6 months LIBOR. And this should include all-in cost, rate of interest, other fee, expenses in foreign currency except commitment fee, prepayment fee, and fee payable and payment of withholding tax in Indian rupees. So except this, everything is covered in this. It's not like our housing loan. When they come to us for a housing loan, they will say rate of interest is only so much, and there will be so many other levies they will add into that. So here that all things are not allowed, except whatever is excluded, everything is covered. In case of fixed rate loan, the swap cost plus margin should be the equivalent of the floating rate plus applicable margin. Now we go to the approval route. So something which is not covered under automatic route, everything falls under approval route. But here also then some restriction is there, that who are eligible borrowers. So again, any Tom, Dick and Harry cannot go under approval route also and can say that I want the approval to borrow money from abroad. Agreement for own lending and specific purpose. Banks, financial institutions participating in textiles, steel restructuring subject to certain conditions. ECB with minimum average maturity of 5 years. Housing finance, SPV. I will not take time to read this whole thing. There are various eligible borrowers are there. Here the restriction is there that if some company is under investigation. Since it is under investigation, although it is covered under automatic route, for rest of the all criteria it is satisfying, but due to whatever reason it is under investigation, then those company also becomes ineligible under automatic route and they have to come under approval route because some investigation is going on against them. All cases falling outside the purview of automatic route and average maturity period will also be covered under approval route. So that average maturity period, whatever we discussed, if we propose to borrow for period less than that, then in that case we have to go to RBI for a specific approval. Who are recognized lender? Whoever are recognized lender under automatic route, all are covered under here. In addition to that, only small changes that when it is coming from a foreign equity holder, there the debt equity ratio was 4:1. Here under approval route it is 7:1. Over and above that, another two categories are there, which is allowed under approval route. Indirect equity holder, subject to indirect holding of at least 51% by the lender in the Indian company. So your parent, instead of parent directly giving loan to you, if its parent or its some other group company, they can also give loan, subject to condition that even their indirect holding is 51%. And the next is also group company provided both borrower and foreign lender are subsidiary of the same parent. So that is possible. That rigidity is not there that only the company which has made investment in the company or in the Indian company, loan should come only from that company.
With regard to this, the use of the money has to be only as per that slide.
Permitted, yeah, permitted. Yeah. So next slide is that. Permitted end use. So permitted end use also again, whatever is there under automatic routes are all permitted end use here. Over and above that, something further is allowed. Like you have seen there, for spectrum allocation it was 2G. So 2G is falling under automatic route, but 3G falls under approval route. Repayment of rupee loan away from domestic banking system. Now this is which was restricted under automatic route, but under approval route it is allowed that you are borrowing for repaying for a domestic borrowing, whatever is there. Repayment of rupee loan and a fresh rupee capital expenditure for company with consistent forex earning up to 10 million scheme. Here's over 10 million. So the consistent earning, it's a very large company and the forex earning is so much, then they are allowed. And the general corporate purpose, which I was telling that which was restricted, which now they have permitted in the month of September, 4th September 2013. With effect from 4th September 2013, eligible Indian borrower can avail ECB from their foreign equity holder for general corporate purpose subject to the following conditions. But then some 2-3 conditions are there and it is subject to approval route, not the automatic route. Minimum paid up equity capital of 25% will be held directly by the overseas lender, which is there in even automatic route also. Such ECB will not be used for any purpose not permitted under the extant ECB guideline. So at the present ECB guideline, something which is not permitted at all, so then money will not be utilized for that. And repayment of the principal shall commence only after completion of minimum average maturity period of 7 years. So temporary working capital financing cannot be done with this. The period is also increased. Even the automatic route it was 3 years, 5 years. Here it is 7 years. So it's a large period. Amount, there the limit was up to 750 million. So if you are going above 750 million, you are under automatic route. For this specified 3 service sector, their limit was 200 million. So if above 200 million you want, then you have to come under automatic route. And maturity period is not specified here. So then maturity period will be decided by RBI on case by case basis because it is approval. But in practice, our experience is there that RBI discourage ECB and they don't easily give approval. All in cost is same what we discussed in the earlier slide. What is is average maturity period? Now this is something even everybody really struggle. And if you see under all route, average maturity period is one of the conditions. So then in practice we have seen that people do struggle to count, because generally what happens when you take ECB, it comes in tranches. Similarly, payment is made in tranches. So in that case, to compute that whether you are satisfying condition of average maturity period of 3 years, 5 years, 7 years, how do you compute? So that's why intentionally I have added one case study in my presentation. So in this case, if you see, the borrowing is 250,000 or 2 million. First tranche came on 11th May of 0.75 second on 5th June 0.50, and third on 31st August. So see how it is calculated. On 11th May, your balance is 0.75. 0.75 balance remain for 24 days because your next tranche came on 5th of June. So 11th May to 5th of June is a 24 days, and here days are calculated assuming year of a 360 days for a simplicity purpose. So for 24 days, you have utilized 0.75 million. So your average maturity for that amount is 0.0250. So like that I have done, and then there is a repayment also. So repayment, if you see, every 6 months repayment is happening after December 08. So if somebody sees the first tranche has come on 11th May 07 and first repayment has made on 27 December 08. So that is around only 1.5 years. So then somebody will say that why average 3-year maturity period is not made, but it's not like that. If you see the calculation, at the end of the repayment of old loan, your average maturity comes to 3.285. Then you are eligible. So it's not that the 3 year has to be computed from the receipt of first tranche to payment of the repayment of the first installment. Under approval route, there are some restrictions on creation of guarantee and security also. For example, for bringing loan from overseas, you cannot ask your banker to give you a guarantee. So bank, financial institution, NBFC, not allowed to give any guarantee or letter of credit or undertaking or letter of comfort for ECB. So you have to bring ECB on your resources, your standing, your strength of the balance sheet. If other banks give you guarantee, then actually it's as more as they are assisting you in financing, which is not allowed. Security you have to give. Nobody is going to give you loan without security. So that it's left to the borrower to decide that what he wants to give as a security. Creation of charge or immovable property or sale subject to prescribed conditions. Some conditions are prescribed. Subject to that, whatever immovable properties are there with the borrower, he can create charge on that. And issue of corporate or personal guarantee is permissible. So the directors of the company, promoters of the company are free to give a personal guarantee for a loan taken by their company. Parking ECB proceeds abroad. Now when some big project is there for which ECB is taken, ECB is allowed, permission is taken, even ECB is released. But you may want some of that money for import of capital goods. Then in that case, if ECB is brought into India, then your foreign currency is converted into Indian rupee, and then subsequently you have to remit it for acquiring some capital goods. Then in that case, you will hit by the difference in the exchange rate. So to protect from that, as per your projection, if already you have planned something to utilize that ECB in foreign currency only, then in those cases you are allowed to park it outside India. Similarly, you may not require the whole bunch of money immediately. Then in that case also, you are allowed to keep money outside India and bring as and when need arises, but with certain restrictions. So the restrictions are ECB proceed for foreign currency expenditure may be one. As I said that if you have to incur some foreign currency expenditure, you keep it outside India, and from there and there only you can make the payment. ECB proceed park overseas permitted to be invested in the following assets outside India. When it's lying outside India, You will not allow it to lie in any current account. So then where you can invest that money? So deposit or certificate of deposit with credit rating of at least AA minus by specified credit rating agency, treasury bill or monetary instrument with 1 year maturity, deposit with overseas branch of Indian Bank. So these are the place where you can temporarily park your money. ECB for rupee expenditure to be remitted to India immediately and parking of proceeds overseas is not allowed. So it's clearly only for a rupee expenditure, then you have to immediately bring it to India.
Sir, in this scenario, how to calculate the eligibility period? From the date of
It has come into your bank account. So
it is parked outside
you
India.
are parked outside India, but it is now your money. So your day starts from that.
Day starts. Okay, not from the day when
No.
it is in India.
No. Your day starts from the day you have withdrawn the money. Because the lender has given you money. Now it is because of your compulsion you are not bringing it to India. But now, as per your balance sheet, it is your liability. But the day the money is released, you have to pass accounting entry in your books. So you become borrower now. So it starts from that day.
Sir, that security you can give only under the approval route. You cannot give it under the auto route.
No, either route.
No,
Secure-
on your previous slide, 25, it's been mentioned only under the approval route. Those three securities, like creation of charge or immovable property, that can be done only under the approval route. That's not possible under auto route.
Okay. On the top I have written approval route. Okay. No, but I think under automatic route also it is allowed.
Both
Yeah.
routes.
Yeah. Refinancing prepayment. Now we already taken the ECB. Is it allowed to refinance? Maturity period has come, but you are not in a position to pay. Then what do? So that is allowed. Fresh ECB is allowed to be raised, but the condition is that it should be lower all-in cost. So whatever previous your ECB was there, now you can't refinance that ECB by borrowing at a higher rate of interest, and outstanding maturity of the original ECB is maintained. So by any chance, if you are getting the ECB now at a lower rate, then you are allowed to do that. It's not that since you don't have money, that's why only you refinance. Sometimes you have money, but you have now another lender available who is ready to give at a lower rate. So then you are allowed to take, but the condition is there that you have to maintain that original maturity period. Prepayment, reverse. Now you have surplus of money, you want to prepay. That also is possible. So if it is borrowed under automatic route, then up to $500 million subject to compliance with minimum average maturity period as applicable. So if it was for a 3-year minimum average maturity period, then you have to keep it for 3 years. If 3 years is over, after that you are allowed to prepay it. Under approval route, prepayment exceeding $500 million. If it is exceeding $500 million, then only under approval route you are allowed to prepay that. Conversion of ECB into equity. Now this is also possible. That foreign parent company has initially financed Indian company by way of a loan as a ECB. Now instead of taking that money back, they want equity shares against that. Originally the object was there that it will be a loan and it will come back. But then now, looking at the business need or whatever, if they want to convert into ECB, then it is permissible. The condition is that under FDI regulation, you should be covered under automatic route of FDI or whatever sectoral cap is there. If for a particular industry there is a sectoral cap for FDI, then after conversion, you should not be breaching that sectoral cap. And the pricing of the share should be as per the guideline under FEMA. Under FDI, guideline is given. So at the time of conversion also, you have to apply that guideline, and accordingly against ECB, that many equity shares can be given.
Sir, what is the position? I want conversion of ECB into CCD or CCPS?
CCD.
ECB into CCD or CCPS? Because FDI policy and master circular has some.
CCD, CCPS all falls under ECB only.
Conversion of CCD into CCD or
CCD means what? Compulsorily convertible debentures.
that is equity.
That is equity, yeah. So no. So on that, FEMA is silent. So then in that case, you have to go to RBI for approval. Because there is no discussion under FEMA, as I mentioned, that unless something is specifically stated, you can't do it.
Because in FDA policy, it says conversion of ECB equal to equity as ECB is. Whereas master circular talks about conversion of ECB to equity and converted debenture. There is a confusion between them.
Okay, okay. Maybe, then I am not aware of that. But if confusion is there, so again, the logic is that don't do anything without RBI approval. Otherwise, you are inviting compounding. And it's always better. See, if you have to face RBI, better face it today instead of doing it later on. Because later on it will be more painful. So whatever has to happen, let it happen today. If they want to say no, let them say no. So then you will be in a position to find some other alternative. But after doing that, then the condition is there under compounding always that first of all you undo that, which probably may not be possible. Because by the time your financial condition may not allow you to do that. And then you have to go for a compounding. So there is a double hit. And compounding is not always easy alternative. Sometimes they may refer it to ED also. And if it goes to ED, then it's a draconian because then straight away you are inviting for a prosecution, etc. So FEMA, we have to be very, very careful while advising to client. And if even iota of doubt is there, better to seek clarification from the authorized dealer. So if authorized dealer is confident of that, you get a letter and keep in your file. And if he is not confident of that, he will refer your matter to the RBI. But not to take risk with the FEMA regulation. Non-convertible, optionally convertible or partly convertible. Now earlier, few years back, confusion was there that where does this all fall? Because it is in the long run it is going to convert into equity, but presently it is in the form of loan, preference, quasi equity. Where does it fall? Whether FDI or ECB. So then RBI clarified that anything which is not straight away equity will all fall under ECB. Otherwise, this is also everybody was trying. That better we bring under FDI rule and as a not as a equity but a preference share, and then over a period of time we will redeem the preference share. So you are not governed by ECB regulation and still you are able to utilize the foreign money. So then they stopped it. So but after recently there is some little you can say liberalization is there. So up to 30 December, anything which is non-convertible, optionally convertible or partly convertible. So except plain vanilla equity, nothing is covered under FDI. Everything falls under ECB. So then for bringing that capital by your preference share, you have to comply with the all ECB regulation what we discussed.
Even though for a compulsory convertible?
No, compulsory convertible is equity. Yeah, because from day one it's very clear. Your schedule is there, conversion period is there, conversion rate is there, everything is there. So, post 30 December, there was a small liberalization in this, that subject to the prescribed condition, optionality clause allowed in the compulsory or mandatorily convertible preference share to be issued. What is that? Although this is a very long provision is there and there are so many conditions are there, but in brief if I will tell that like presently either it is a equity or it is a ECB, very stringent. So under this now even the foreign shareholders are allowed to put a clause that over a period of time if they want to go back, then they are allowed to have a put option. So then in the agreement itself when the money is coming, they keep a put option that after certain year, if I want to exit, then I can exit subject to the pricing guideline under FTA. So in this case, here little window is open that even though you have come as an equity shareholder, still you can take back your money. The other is that, which is a circular number 84 dated 6 January, it actually simultaneously came. Indian company may issue non-convertible redeemable preference share to non-resident shareholder by way of a distribution as bonus. So now we have an equity shareholder, they are non-resident. You have a substantial reserve is there, but instead of giving a bonus in the form of equity share, you want to give in the form of non-convertible redeemable preference share, then now it is allowed post 30 December. But in this case actually there is no inflow. It's just passing of journal entry, you are converting your reserve into equity.
Sir, can you explain the
Second one.
Yes.
Second one. Indian company is a foreign equity shareholder. It is a foreign equity. Now it has a substantial reserve. They want to utilize that reserve. In normal course utilization of reserve, only two options are there. Either you pay dividend or you pay bonus, or at the most buyback. Here this is another window is open that you can utilize that reserve for issue of non-convertible or redeemable preference share to your equity shareholder. So equity shareholder will receive as a bonus instead of equity share non-convertible or redeemable preference share. Generally the object here is that preference share, then you have like some certain fixed percentage of dividend. So that's where this is generally used. That if the prescribed rate is there, then foreign investor has some comfort that okay, this much dividend is going to come. That's why. Although this is a new thing is there, so not yet very you can say, yeah.
All the reporting compliances have to be done for issue.
Yeah. Yeah. No, for this one. This will be covered as the FDA. Yeah. We discussed the branches of a foreign bank in India. Pardon? Subordinate? What is subordinate debt? But they are allowed for a loan also. See, it's a branch of a foreign company. So equity will not be there. So in the branch of a foreign company in India, any bank, take Citibank, HSBC, subject to the limit what we discussed, they are allowed to take loan. In fact, they are running business through that loan only. Now we go to the trade credit.
We cannot pay interest even as per the ceiling.
No, but whether interest, what is the rate of interest? I don't think that there is any ceiling on rate of interest. It's not there. No. You see the borrowing in foreign currency. So it's not there. You see slide number 7. Borrowing from its head office or branch or correspondent outside India up to 50% of its unimpaid Tier 1 capital or $10 billion, whichever is higher, subject to conditions of the RBI. So there will be some certain prescribed condition over there. Which one? No, that is not for that. That is for a ECB under approval route. That's not for that. Yeah, now we come to the trade credit. So trade credit is something like the credit which you are getting from your vendor against import. So as earlier I mentioned that up to 6 months it is allowed. The moment it crosses 6 months, automatically it partake character of the trade credit. So you are supposed to inform to your authorized dealer. And so for trade credit, certain restrictions are there. First of all, reporting